Something occurred in the housing market that economists privately hoped we would never witness again in our lifetimes. Not just a warning signal, not just concerning data, but a convergence of multiple indicators simultaneously flashing red, creating a pattern that looks disturbingly, unmistakably similar to what we observed in the lead up to the 2008 financial crisis. Except this time, the underlying mathematics point toward something potentially more severe, more structurally damaging, not because of subprime mortgages flooding the system, not because of Wall Street gambling with mortgage-backed securities, but because housing prices have drifted so catastrophically far from actual earned incomes that the entire market is essentially floating on borrowed gravity, sustained only by momentum and the collective refusal to acknowledge what the numbers are screaming. If current trajectories continue uninterrupted into 2025, we are positioned on the edge of a structural correction, not a cyclical one that naturally self-corrects. And the data forming underneath the surface, invisible to casual observers, but clear as day to anyone analyzing the fundamentals, is already visible and measurable to anyone willing to look beyond headlines and actually examine the numbers. Today, we're going to systematically walk you through the speculative scenario that many housing economists, the serious ones who predicted 2008, are quietly discussing behind closed doors at conferences and in private communications. A scenario that transitions from theoretical possibility to practical probability if current trajectories remain fundamentally unchanged. Let's begin with the most alarming indicator. If today's price appreciation trends continue on their current path, the inflation-adjusted Case-Shiller Home Price Index could reach the 299 to 300 range by late 2025, levels never before recorded in the entire documented history of American real estate. For critical context, that reveals how unprecedented this would be. The 2006 peak, the absolute top before the market collapsed, registered at just 266 on the index. Even after adjusting for inflation, wage growth, population increases, and every other demographic factor, a 2025 reading approaching 300 would definitively mean that housing has drifted further from underlying economic fundamentals than at any point in recorded American history. This is the first major warning signal in this scenario. Home prices continuing to outpace actual earned incomes at a rate that historical analysis conclusively shows is mathematically unsustainable over any extended period. And if this trend continues unchecked, the average American family could be forced to allocate 40 to 45% of their gross income just to afford the median-priced home in their market. Financial planners and economists universally recommend 30% as the absolute maximum for housing costs. Anything consistently above 40% historically triggers corrections. And when 70 to 75% of households become completely priced out of purchasing new homes, unable to even qualify for mortgages, that is precisely when housing transitions from functioning as a normal asset class to operating as an economic pressure cooker, building toward inevitable release. In this scenario, 2025 becomes the critical turning point, the year when unsustainable trends reach their mathematical breaking point. If mortgage rates remain stubbornly elevated in the 6 to 7% range, even accounting for potential small Federal Reserve rate cuts, the payment shock phenomenon could become the defining structural fracture that breaks the market's back. Let's examine this with concrete numbers that reveal the problem. A buyer in 2025 purchasing a home at current price trajectories combined with current interest rates might pay $600 to $700 more per month than someone who purchased an identical property in 2020. That's not inflation affecting the calculation. That's pure structural distortion. That's the market fundamentally breaking. Even if rates somehow drop to 0%, yes, literal zero, prices in many major markets would still be historically unaffordable based on median local incomes. That's how severely stretched the ratios between price and income have become. And when affordability collapses to these levels, something else inevitable happens. People stop moving, mobility freezes. The rate lock effect, where existing homeowners are trapped in 2 to 3% mortgages they can never economically replace, freezes supply completely. This creates a vicious cycle. Supply freezes. Builders panic because they can't sell new inventory, and then the next domino in the chain hits hard. If current building trends continue their trajectory into 2025, We could witness something that precisely mirrors the early warnings that appeared in 2007 before most people recognized the crisis. Building permits dropping double digits year over year. Housing starts falling steadily month after month. Completed homes sitting unsold for extended periods. Builders systematically canceling future development projects. And here's the visual that captures this moment. Imagine driving through a brand new subdivision. Streets fully paved and perfect. Streetlights installed and functional. Utilities connected underground. But every single empty lot sitting completely untouched, no construction activity whatsoever, because builders pulled out of commitments. Not because they want to abandon projects, not because they're being irrational, but because the fundamental numbers no longer work at any realistic price point. In this scenario, unsold inventory climbs above 400,000 to 500,000 new homes nationwide, levels we haven't witnessed since the last major housing crash. The construction industry begins retreating strategically months before average consumers even notice something is wrong. Builders always know before the public recognizes the problem. They see qualified demand evaporate in real time while the rest of the country still thinks the market is perfectly safe and sustainable. That's exactly what makes this warning so critical and time-sensitive. To be absolutely clear, this scenario is not based on a subprime mortgage collapse like 2008. The mechanics are different. Instead, the pressure accumulates from consumer debt reaching unsustainable levels, rising delinquencies across multiple categories, unaffordable mortgage resets for recent buyers who took adjustable rates, insurance, and property tax spikes that weren't factored into original affordability calculations, and job market cooling in economically vulnerable high-risk cities. If the current trajectory continues unchanged, foreclosure activity could climb steadily for 6 to 12 consecutive months. Not a dramatic wave, not a tsunami that makes headlines, but a slow, grinding increase that signals households are systematically running out of financial margin and flexibility. In this speculative 2025 timeline, foreclosure filings rise 10 to 20% year over year. Bank repossessions increase. Foreclosure auction starts tick upward. Credit card delinquencies hit multi-year highs. Student loan delinquencies, now that payments have resumed, tick measurably upward. These are the pressure cracks forming in the foundation. They always appear before the structural break occurs. Every housing correction in documented history starts locally in specific vulnerable markets before it metastasizes into a national phenomenon. If current trends hold firm, the earliest visible signs of a 2025 correction would likely appear first in these specific regions. The Southwest boom cities: Phoenix, Las Vegas, Reno. These markets experienced rapid migration that has now reversed. Inventory is visibly swelling. Prices are slipping from what were clearly unsustainable highs. The pandemic boom towns: Austin, Boise, Denver. These experienced heavily speculative demand driven by temporary conditions. They have dangerously high price-to-income ratios. Developers are already visibly slowing construction activity. The Florida Gulf Coast markets: Cape Coral, Fort Myers, Naples. These face an insurance crisis that's fundamentally repricing risk. Flood risk recalculations are making ownership untenable. Snowbird demand from retirees is measurably softening. The pattern sequence is always identical across market cycles. High-growth cities stall first. Price cuts begin appearing. Inventory jumps noticeably. Buyers pull back and adopt wait-and-see positions. The correction spreads outward geographically from these epicenters, exactly like the 2006 to 2008 sequence. But this time, the underlying drivers are fundamentally different. Which brings us to why this scenario could potentially be worse than 2008. In 2008, the core problem was debt, specifically bad mortgage debt. In 2025, the fundamental problem could be pure affordability disconnected from income. That's reality. Here's the critical distinction. Debt can be refinanced when rates drop. Bad loans can be restructured through modifications. Banks can be bailed out by government intervention. But you cannot refinance affordability back into existence. You cannot bail out an entire generation that simply cannot afford to purchase homes at current price levels regardless of interest rates. That is what makes this scenario uniquely dangerous and resistant to traditional policy solutions. This time, the bubble isn't built on fraudulent mortgages or predatory lending. It's built on economic reality diverging completely from price reality. And when those two forces eventually reconnect, as they always mathematically must, the correction is blunt, sudden, and non-negotiable. In this speculative 2025 scenario, we also observe something highly unusual: corporations telegraphing serious trouble before the general public recognizes anything is wrong. Major homebuilders quietly cutting land acquisition. Retail home improvement chains reporting unexpected sales declines. Insurance companies abruptly exiting entire states. These corporations are never emotional. They don't panic irrationally. They don't get swept up in hype or sentiment. They move precisely when the mathematics move, when their models shift. And the math is telling them something the mainstream headlines aren't reporting. Housing is systematically mispriced relative to fundamentals. Here's the real danger point in this timeline that creates maximum damage. When affordability collapses and rates stay moderately elevated, you get a toxic combination. Too many sellers who cannot sell without taking losses, too many buyers who cannot qualify to buy, builders who will not build because projects don't pencil, investors who will not take risks in a falling market. This creates what economists call a market freeze, not a dramatic crash. Everything slows to near immobility. Everything stalls. Everything seizes up mechanically. And that is precisely when price corrections accelerate most rapidly, not because of panic or emotion, but because of pure mathematics and the inability to sustain artificial price levels. This is where the speculative scenario transitions into practical implications. If trends continue on their current trajectory, 2025 becomes a year defined by radically different conditions for different participants. For home buyers, greater bargaining power returns. More inventory to choose from, lower prices from desperate builders, higher closing incentives and concessions, but also significant risk of buying before a wider correction fully plays out. For current homeowners, protection from low-rate mortgages locked in, but serious danger if living in early correction markets. Insurance and tax pressures remain growing threats regardless of equity. For real estate investors, this becomes strictly a patient capital market, not the environment for flipping properties, not the market for high leverage strategies. The best opportunities emerge after corrections begin, not before. For renters, falling rents in oversupplied cities, increased negotiating power with landlords, rising availability in major metros. If this scenario plays out as the data suggests, the defining question of 2025 will be this: how long can housing remain fundamentally disconnected from income reality before the correction becomes mathematically unavoidable? No housing market in recorded history has sustained record-high price-to-income ratios indefinitely. Not Japan in the 1980s bubble, not the United States in the early 2000s, not Canada today, not China's property sector today. Gravity always wins eventually. The question isn't if the correction comes, it's how it manifests and which cities experience it first and most severely. If you live in Phoenix, Austin, Tampa, Denver, Boise, or anywhere along the Florida Gulf Coast, you are watching the future of the American housing market happen in real time in your local area. Your ground-level observations matter enormously for understanding what's coming. The data forming now will define the next cycle.